Hi everyone, this is Jason Burak of Wall Street from Main Street. I just wanted to do a short video today. Today is April 27th. It's almost the end of April. We're almost to May, almost to the summer. It's nice and spring now here in the DC metro area. But there is an important story on Zero Hedge, and this is a mainstream trader, commodities trader. It says, what is happening is absolutely no reasonable explanation. I'll put the link to the story. I wanted to comment on it. Basically, there's a bunch of emails back and forth between traders. I guess Zero Hedge got their hands on it. The guy's saying that there's all these extra bids and volume coming in from in the commodities markets, and he's saying that supply and demand fundamentals, there should be no long side bids for this. I think the guy is missing some of the point here. You know, his theory is that the central banks, whether it's the Federal Reserve or others, are coming in and buying long contracts and trying to get inflationary expectations up, trying to manipulate the inflation numbers higher. That's his theory. I think he's wrong, and I'll explain why. I think the goal of central planners, the goal of central banking, first, central banking is manipulation in general. The goal is to manipulate interest rates and to manipulate the money supply. But the goal is to stagflate and lie. They want to hide the inflation. So let me lay out the case for why I think, this trader is wrong, that I don't think it's the central banks coming in, although, there are central banks that are giving away credit, and maybe this is an effect of this. But the goal really is not to get commodity price inflation that hits the real economy, because then, people wake up that, oh, there's massive amounts of inflation. The goal was to stick massive amounts of inflation into the asset markets, and this has been going on for decades. But nothing the central banks do nowadays would surprise me, so maybe this is part of it, but I really don't think so. Okay, well, in terms of one of the things I wanted to talk about why I think the central banks aren't trying to manipulate commodity prices higher, this has to do with a number of things. There's an excellent article from Peter Warburton. He wrote this in April 9th, 2001, so this isn't a very old article. He's a British economist. He worked, I think, in London in the financial area. He worked in academia. He tends to be more open-minded than I'd say Keynesians. I wouldn't call him a Keynesian, but he said that gold was going to do well for starting a very long time ago, and other hard assets were going to do well. But he talks about his research and the debasement of world currency. It's inflation, but not as we know it. Gata has this article. I'll put a link to it. I really think you guys should read it. And basically, to summarize parts of this article that I think are important, I read this article maybe 4 or 5 years ago when I was first waking up. 2009, 2010, 2011, sometimes around that time frame. I think this article is important. It basically shows that the goal of all these major economies, their treasury departments, their central banks, was to create as much monetary inflation as possible and hide that inflation, give the money to Wall Street and those guys, but put it in the derivatives market. So a lot of that money, the inflation, the monetary inflation, wouldn't hit the real economy nearly as much. It wouldn't hyperinflate things as quickly. So most people wouldn't notice the massive amounts of inflation going on. And that's how, Wall Street, starting in 1971, but with the creation of derivatives and the dollar became fully unbacked from gold, then the US dollar became fully unbacked from gold. Then that allowed the Wall Street banks and the other guys to start creating these derivatives markets and start creating massive amounts of inflation and credit in the asset markets, either reflating assets, or credit bubbles, or creating new ones. So I think this Peter Warburton article, it outlines that this guy is wrong, that central banks don't want the real commodity prices to go higher in real terms. They wanted the inflation that they created over the decades to go to Wall Street in paper trading profits, into the asset markets, into the derivatives market. So a lot more of the inflation that was created wouldn't hit the real economy. I think, one of the things that could be happening also is that OPEC, which is a cartel, and people think, oh, cartels only want higher prices. Not necessarily. Cartels, when they're formed, they could want to move prices high for a certain period of time for some reasons and manipulate prices low to knock out competitors and gain market share. So I think OPEC was involved in either OPEC and Wall Street, maybe they were in cahoots at some point in trying to bankrupt the shale guys. So maybe it was Saudi Arabia and Russia teamed up and maybe they hired Wall Street banks to help knock the oil price down to try to bankrupt shale companies, and it backfired. And maybe now, because these oil producing countries are in so much pain, maybe they tried to get the paper futures market in oil rally. There was a record amount of oil futures longs, just like there was a record amount of oil futures short X number of months ago. It is kind of reversed. And, obviously the oil rally is sputtering out, but there's going to be real world consequences to these things. So one thing these commodities traders who are sending these emails back and forth, they also didn't notice was that the currency prices are fluctuating. So yes, they're looking at supply and demand and saying there's no way these commodity prices should be rising given supply demand fundamentals. There's no way the volume of these contracts, and it's the central banks coming in and buying these things. Maybe there is a little bit of plausibility of that. Maybe it's China giving excess credit to their traders, allowing Chinese banks or Chinese commodity traders too much credit to go in there and speculate in the commodities markets. But I think what they're also missing is the fluctuations in the currency markets. These commodities traders that are looking just at supply demand of the commodity, they're not properly factoring in to their calculations the fluctuations in the currency markets. So if the US dollar goes down a lot, that would obviously, in dollar terms, the price of oil would have to go up a lot, because it just would have to. Gold and silver would correspond. Normally, now this isn't always the case. So if the dollar is strong sometimes, gold and silver can also be strong. So correlations can change. But if a particular currency is going down a lot enormously fast, and the currency happens to be the US dollar, and recently the dollar has had a little bit of a slide, quite a bit from its highs, 5-6 months ago on the dollar index, then, that could account for the supply, offsetting the supply demand fundamentals where the commodity prices have had a bit of a rally. That could be definitely part of it. The other part is there's going to be supply side problems in certain commodities markets because a lot of the producers haven't been making money for years. At some point, and I think a lot of these traders, they just look at the Wall Street Investment Bank reports. They don't go and talk to the industry guys. They don't go to conferences with the industry guys. They don't speak to a lot of the miners or the farmers and things like that. They expect the investment banks to provide them good research. In a lot of cases, the investment banks don't do the best research, or the research is, so different and it's all over the place. They don't know what to believe. But in a lot of cases, these farmers, these miners, these oil producers, for a number of years now, they haven't been making much money. And maybe they've been able to borrow. There's a Zero Hedge article about this. Why are bankrupt oil companies still pumping? And the answer is, even though they're bankrupt, some of them are still getting credit. And even in the bankruptcy court, some of them are still that are in bankruptcy court for a year now. They're still able to figure out how to get credit to do this. So we have a lot of crazy things going now in the global economy. And just to say, guarantee these guys theorizing that, it's the central banks going there and buying it. The central banks want to create all this inflation. They don't like deflation, these Keynesian central bankers. But they have tried to prevent, and they've done this with the games with changing the CPI, the consumer price index, so many different times. They have tried to hide the inflation. So why would they go in there, change everything that their policy decisions that they've been doing for decades of stagflating and lying, trying to hide the inflation, sweep it under the rug, like that bad dog owner who doesn't, scoop up the poop and put it in the trash or compost it or whatever, who just, sweeps it under the rug so his wife doesn't notice. And now there's a huge pile underneath the rug, and it smells like really, really funky in the house or the apartment. So that's what central banks have been doing with the inflation statistics, the CPI, is they know that they've been creating massive amounts of inflation for decades, and they've been just trying to hide it either with phony economic statistics or whatever. So I don't know. I really don't think it's the central banks going in there and buying futures contracts, trying to drive up the gold price or agricultural prices or silver price or oil price or any of those. I think, it's probably for oil price, there's been games been played with, OPEC's been doing it, and maybe it's Wall Street banks doing it. Maybe it's individual oil producing countries like Saudi Arabia who still have, a massive amount of sovereign wealth fund, although they've been selling some of it, but maybe they would be incentive to do it. I'll provide you guys an example. If you're making tens of billions of dollars a year in oil revenue, what's to stop you then from spending, 10% of those oil profits on manipulating the oil futures market? So there's a good amount of paper oil contracts out there. There's a lot of paper barrels of oil, not as much paper oil as paper gold or paper silver, but still, it's pretty darn high. So there's games that can be played. I don't think it's the central banks, though, that are directly going in there and buying commodities futures contracts to trick people, into that, now we have inflationary expectations. I think these guys in the article, I don't think they fully get it. They don't have the Austrian School free market perspective. They haven't read Peter Warburton's article. The other thing I would also add here, the last thing I wanted to bring up is Hyman Minsky. One thing about Hyman Minsky, he wrote this. Let me pull up the PDF here. It's his financial instability hypothesis. It's about 10 pages PDF. You can Google it and you can read it. He basically says that central banks, I guess he's the father of modern monetary theory, MMT. His idea is derived from it. A derived MMT. MMT obviously came later. But what he says, though, is central banks provide stability. I would argue the exact opposite. I would say that central banks provide an illusion of stability. So I would say, for 5 years, 7 years, 10 years, maybe 12 years, things look good because the central banks, Federal Reserve or others, did currency swaps or created new bubbles or reinflated an asset bubble and just papered over a problem. And for most people, they're so short-sighted and myopic, they're Keynesian, maybe they've made a lot of money off this bubble, so they're not willing to look at things objectively. But, this is something that a lot of people in the financial industry talk about, Minsky moment and financial instability, the financial instability hypothesis of Minsky, and he gets a lot of credit for it, but I think he's a statist. I think if you actually go read through some of his work, he actually agrees with Keynes and Marx on a number of other stuff too, in terms of things, for his views of how the economy should be run properly with central planning and big government and regulation and things like that, and how capitalism can destroy itself. So I think when you add this all up, guys, I would just say that this Zero Hedge article, these mainstream Wall Street guys who've made a lot of money probably over the years trading commodities back and forth, why they're probably losing money in the markets right now is they don't fully understand the goals of the central planners, these Keynesian central bankers, these people running the Treasury departments, the Bank of International Settlements, and so many of these other, statists and central planners, what the real goals are. The goals are, and we've said this on our channel repeatedly, stagflate and lie. To try to keep the asset markets mostly propped up. Occasionally they will let them fall when they have a good idea they're going to fall, and then they'll come in and maybe buy up the assets for pennies, and then they'll reflate them, and then maybe they'll sell for big profits. They've done this a number of times. 2008, we knew after 2008 crash that there was going to be an attempt to massive reflate it. It was obvious that they weren't going to just let it continue to fall without trying and doing something. I don't know how much more ammo these central banks have. They obviously have currency swaps that they can do. They're doing a lot of them now. They've done over 19 trillion since the 2008 crash. We know that from the one-time partial audit Ron Paul got at the Federal Reserve. So there's a lot more than 19 trillion in extra money and credit and currency swaps, which are basically enormous interest-free loans that have been propped into the system just to keep the asset prices from falling tomorrow. So we'll see what happens going forward, guys. I think these traders, obviously these guys are not stupid, but they just don't understand the world through a free market Austrian school lens, and they don't understand the goal of central planners. The goal of the central planners is to hide the inflation, which they've been able to do for most Americans. They've been hiding in asset prices, and they've been fooling people with the jobs numbers and CPI and things like that. So I don't think the central planners, after decades of policy decisions that they've decided they want to keep changing the CPI and hiding inflation, I don't think all of a sudden they'd go in there and start buying gold futures contracts or silver futures contracts on the long side to try and fool people that there's inflation. Anyways, guys, comment on this if you want to. Wall Street from Main Street, we've been speaking with angel investors still. They love our business plan and think that we can really build something. They say, though, for us to get some really large checks, six figures checks, or up to $1 million in investment, we need to hire a CEO, a more experienced one. So someone with business experience, day-to-day operations, who has marketing experience and a good background. If you're interested in that or can make referrals, please email us wallstreetfrommainstreet@gmail.com. Otherwise, keep giving us 5-star iTunes reviews, and we're going to keep cranking out these videos. We're almost to 1.6 million views already. And guys, people are starting to notice the quality of my work. I just got an invitation to go to Google actually invited me to their Washington, D.C. office in 2 weeks because my channel is having such success. So it has so many subscribers and views. I actually got invited to meet them there. So I'm really excited about that. Obviously, without you guys, commenting and liking the videos and sharing them, that never would have happened. I'd like to be able one of these days to actually make good money off this channel, either managing money with Modawood as a hedge fund long short, using our Austrian school principles for value investments and maybe a mix of options trading, and then also building up this educational technology company where people can learn to invest in different asset classes, learn Austrian school economics and entrepreneurship for a much more affordable price, than paying $40,000 a year for textbooks and things like the living expenses at a mediocre or bad business college where the piece of paper is not going to really get you anything and you can actually learn from successful people. So thanks guys for watching this video. I'm going to keep doing more short videos. I'm going to mix them in. And we got 2 exciting guests coming up. We got 2 oil and natural gas experts coming on this week. We got Elliot Gue, who was last on in December of 2014, and we have Dr. Kent Moore is on later in the week, and Moda Wood is also interviewing John Rubino this week. So there's a lot of great content coming up. I'm trying to get on other great people again, like David McElvaney, Eric Sprott, Bill Holter. We're going to keep cranking this out. We're almost to 1.6 million views. We should be a lot higher than that. We should be over 2 million already and kicking ass and taking names. Maybe one of these days we'll get Ron Paul on. Okay, guys, thanks.